So one of the things that we do, and we think about this a lot, is we actually build the case with the startup. So we can talk about the TELUS approach to things, but like we build a strategy with the business unit that we're working with at TELUS. And then we build the case. So we say, if we go ahead and make this investment, we think in the next 5 years, we're going to get $7 million. And these are the assumptions that we're making. And we'll actually share that with portfolio companies to say, look, this is what we're building. Second, third order magnitude decisions like, do you have enough support to manage this volume? If something fails, do you have redundancy? Like, it's operationalizing the consequence of getting access to a channel like that. And that's one of the reasons why it's super important for the work that we do.
Welcome back to Tank Talks. I'm your host, Matt Cohen. And on today's episode, we've got a powerhouse guest joining us with Terry Doyle from TELUS Global Ventures. You know, Terry's got a pretty unique perspective on corporate venture capital. Over the past few years, he's been at the helm of TELUS Global Ventures, driving investments across 5 continents, 150 companies, and deploying over $175 million in just 2023 alone. That's some serious scale. And today, we're diving into how Terry has helped scale TELUS's corporate venture fund strategy and what makes it stand out from traditional VC funds. We'll talk about their focus on sectors like ag tech, health, and consumer digital, and how they balance financial and strategic returns while pushing for commercial agreements within just 2 years of investing. We'll also explore the global challenges and opportunities in the venture world with insights into Terry's leadership at TELUS and his role at C100 and how he's supporting Canada's tech ecosystem on the world stage. This is a must listen for anyone curious about corporate venture capital at scale and how TELUS is shaping the future of tech. So let's jump into the tank with Terry Doyle from TELUS Global Ventures. Thanks for joining us in the tank today, Terry.
Thank you for having me. I appreciate you spending the time.
You know, Terry, you have been in and around startups, technology, investing, and venture capital for quite some time. I'm not going to age you, but for some of our younger listeners, can you maybe share your journey, sort of where you grew up, your early professional career highlights, and how you ended up in the corporate venture capital world?
I am a proud Canadian. Although I was born in Australia, I consider myself in dog breeding terms kind of a mutt. My mother is Canadian and my father is Irish, and we grew up all over the world. I have 4 older siblings and we were all born in different parts of the world. The opportunity to grow up in Canada and did a couple of law degrees in Montreal before quickly realizing that the world did not need Terry as a lawyer. And so I'm a recovering lawyer and figured out very quickly that I could use some of my legal skills, negotiation, structuring, transactional skills to get into business development. So a couple of centuries ago, during the first .com bubble, I was doing BD all over the world for a wireless middleware company based out of Toronto called Wisdom with a Y. That really sort of gave me wow, this is fun and interesting, and working with growth companies is great. I moved to the UK, to London, doing some kind of unusual work. Started with British Telecom, where I helped them license a patent portfolio of about 40,000 patents, which at the time was the second or maybe the largest. It was up there with IBM's patent portfolio and had never been licensed. I like to call it a Crocodile Dundee approach to how they license their intellectual property. If somebody ever came to them and said, hey, we think you're infringing on our patents, they'd say, you call that a knife? Here are 40,000 patents that you may be using. So it was sort of a deterrent, and we turned it into a revenue stream for the company, effectively sweating the assets. And that got my deal. Patent assertions are like altitude training for transactions. They're really hard. So anything after that felt really easy. And so I wound up getting pulled into M&A, and I started doing M&A all over the world for British Telecom. They moved me to the US in 2007. I subsequently moved to Nokia, which was a very interesting time to be there. Watched the business turn the corner in a not such a great way, but was involved in negotiating the plan B as we were selling the handset business to Microsoft, as an example.
You joined Nokia pretty much at the time of the launch of the iPhone, correct? Or just after?
Yeah, it was a really eye-opening experience because of inside the headquarters at Espo, you saw people who are like, this iPhone is a terrible phone. Like, why would anybody buy it? We have such better technology. It was a real eye-opener for how you can be blindsided by your own sort of press. And to be clear, like Nokia at that point was the number one handset manufacturer for
Right.
14 years. And I'm sure you probably have listeners who, have a candy bar Nokia in a drawer somewhere. And if they tried, it would boot up and could run over with a truck. And it was a great device.
What was your initial reaction, though, when you saw the launch of the iPhone, when Steve Jobs was famously holding it up?
It was hard because, I was surrounded by people who were saying like, it's a terrible phone. And it was hard to point out that like, this is not about it being a phone anymore.
Phone.
To be clear, like Nokia had already created the category. They had something called Nokia Communicator, which had like a full keyboard, a screen. Like they did it well before the iPhone came out, but they weren't getting the ecosystem play, the developer play, and then the consumption of content, which was really driven by the iPod. It was hard. It was very hard. And I actually ran a team that did like external intelligence as one of the many things I did for the company. And I was bringing them data all the time saying like, look at the penetration of this device, look at the developer community. And so it was hard. It was really hard. And unfortunately, the business did not respond as well as it could have to the threat. And we saw what happened.
Life lesson from that you kind of hold on to today, not to shoot from the hip, but sort of maybe just don't ignore the naysayers.
Andy Grove quite famously said the paranoid survive, like not a terrible thing to remember. Also that the engineering culture at Nokia was really strong, like incredible engineers. And the engineering departments would actually wind up competing with each other to come up with the more elaborate, some of the, menu structures in some of the devices were just 47 clicks through. And they were forgetting about the customer. And I think anything that Amazon has taught everybody is like, start from the customer and work your way back. I think Nokia may have lost that view at a certain point.
Also, I think the feeling of taste and touch and all those things, yes, maybe not things that you could, get in a focus group, right? But engineers don't often think about those things.
Yeah, we had some of the best industrial designers in the world. In fact, during the subsequent litigation between Apple and Samsung, once we were in the process of selling the handset business into Nokia, Samsung's defense was, hey, you can't, there was an infringement around design. And basically Samsung's like, well, you can't design anything new, like it's a brick. Apple went to court and said, look at Nokia, look at the Windows phone that Nokia has built with Microsoft. Like, this is beautiful design. And it was. There's a lot of things that can go wrong in consumer hardware, managing long supply chains, worldwide distribution. It's a really complex business. And the Finns and the folks at Nokia should be incredibly proud of the business they built. It's just, at a certain point, you're going to miss a shift and you make hay for it.
Yeah. Hey, worst thing is they make a movie about you like they did for the BlackBerry folks. So, hey, move on from there, right? But you ended up over at Microsoft, which I guess had a kind of connection to the devices space for a brief amount of time leading business development.
That was a super interesting experience as well. This is before, it was still under Ballmer, and this is before Satya came in. And again, like, Satya's one of the best leaders in technology for a lot of reasons, but one of them was he managed to, turn the view that people have of Microsoft around in Silicon Valley. So when I was working for Microsoft, I would have rather have said, living where I live in Silicon Valley, I would have rather have said, like, I worked for the IRS because really there was so much bad will. Satya completely changed that view. And he's gone from strength to strength, not just in the cloud business, but obviously most recently in the whole OpenAI bets that he's making. But like, it's an incredible machine. You get, like, I've worked for big multinationals, and scale is something you just don't get your head around until you work at a place like Microsoft. I used to pitch, $400 to $700 million deals. And people are like, why would I even look at that?
That's unbelievable.
That's not even a wrap. The business doesn't even report revenues below $1 billion. It's just, you don't really truly understand scale until you're in
I want to double click on that, because you've spent your life around corporates, multinationals, big public companies, and you just talk about the scale. I think for a lot of our listeners, especially young, first-time founders, Canadian founders, the level of scale at which you've been in negotiations for, in the boardrooms and acquisitions and things like that. What is it about the people in those in those situations that respond differently to bad outcomes and good outcomes? And how do they think about processing all the moving parts so that it doesn't become overly consuming that they can't even make progress?
It's a good question, and one we could probably spend the rest of the podcast talking about. I'll give some key learning points. One is you have to create context or frameworks for decision, right? So you have to understand if you're about to acquire a business, which is a significant business, what level of materiality will there be in the revenues that you're forecasting to have the business, and you bake into that. Say it's an acquisition, you know, the risk, especially as you get bigger, the risk that you have in acquiring a business and all the potentially negative things that you don't know about. You can do lots of due diligence, but there's always surprises once you get the keys, is the risk of a significant lawsuit worth the revenues that you may get for. So you start to balance out decisions like that. And then you also have to do the build buy, and a classic example of this was in Microsoft. Again, you'd be pitching deals and the first response back would be, we could put 1,500 engineers on that and we'll do it tomorrow. And so you have to have this very awkward conversation of like, okay, well, you haven't. And,
Right.
and if you did, it would take you another 2 years, possibly 3. And in that time, the market would have moved. So what's more important, market timing or you doing it on your own? It's much more around, it's not so much the size of the number, though that's important. It's more about creating decision-making frameworks that allow you to be able to make a judgment against a number of competing things, like risk of, inheriting something that you don't really want to deal with, or failure to execute, or size of markets that you're going after. In the world of M&A, you're either acquiring somebody else's customers to sell them your stuff, or you're acquiring a product to sell to your customers, right?
Right.
Those are really the only two models that work.
That framework, though, it must change company to company when you were in those boardrooms. Are there ones that you saw work only at large scales, or ones that could also be applied to maybe a smaller company? Because right now, let's face it, we have Series B companies doing acquisitions that could be transformational to their startup.
The other thing that you've got to keep in mind is install base and the potential for, the same thing that gives you access to, significant revenues. If I'll use an example from my current job at TELUS, we have a significant digital health business. We cover 75 million lives with employer-employee benefits. If I invest in a digital mental health startup, they get 75 million potential customers the next day. Well, the risk is that you've missed something and then the company can't deliver, right? And so you've got reputational risk. And so smaller companies running fast and breaking things, to sort of mangle the Facebook quote. The idea that you can do that much easier at a smaller, more nimble company, or a company that has less of a reputation to manage, makes it much easier for you to make those sort of decisions where it's like, we'll take the risk, we'll put this new product and we'll do everything we can to make it work. But if you're doing that at 75 million lives, the level of problems that you build, you create for yourself is pretty substantial.
How much?
Yeah,
totally. But how much does a startup, let's say that you're talking to, the telemedicine startup, need to understand that and also kind of defend themselves against that? Because of course it's TELUS's, let's say, purview to say, we know the risk, but does the startup also need to be defending against those risks as well, even though they've never even seen them before?
So one of the things that we do, and we think about this a lot, is we actually build the case with the startup. So we can talk about the TELUS approach to things, but like we build a strategy with the business unit that we're working with at TELUS. And then we build the case. So we say, if we go ahead and make this investment, we think in the next 5 years, we're going to get to TELUS $7 million. And these are the assumptions that we're making. And we'll actually share that with portfolio companies to say, look, like second, third order magnitude decisions, like, do you have enough support to manage this volume? If something fails, do you have redundancy? Like, it's operationalizing the consequence of getting access to a channel like that. And that's one of the reasons why it's super important for the work that we do.
That is such good advice for startup founders, because I think they don't understand that. They only look at the pure optimistic view of like, what happens if we're together? How much more can we sell and more can we grow? But also the redundancy part of like, what happens if it's too much? Or what happens if something breaks in the chain because of this optimistic opportunity in front of us that destroys maybe our reputation? Because the saying is, it takes 10 years to make a company's reputation. It takes 10 minutes to destroy it. And I feel like in the corporate development world, that is a huge conversation that a lot of startups don't understand.
Yeah. I mean, I'd say to any of your listeners thinking about, selling themselves to a corporate, like the conversation about integration and being successful, because anybody can price an asset. Like you can always come to an agreement on how much to buy a business for. But where most acquisitions, for example, fail is actually on the integration, right?
Totally.
We say we're going to buy the company for 10, and we know that there are all these synergies that result, positive and negative synergies. And so we say, "Cool, here's how we plan to sell this once you're part of us. And here's what it means to be part of us."
Right.
If you have that level of understanding, there's going to be way less surprises. Most founders are like, "Wait, I'm going to get paid 10 for my business. Wow, this is
Right.
great." And I'm thinking about my new car and blah, blah, blah. Like, trust me, you're going to be at the company for at least 3 years to earn the price that they paid for you. And as a result, like you really, really want to make sure that you've got a clear understanding of how everybody's going to work. Just like we do with our investments in the case of acquisitions, like integration starts like when we're still negotiating and we start to talk about all the assumptions we're making along the way. So nobody's surprised.
That's why there's full integration teams dedicated to some of the biggest and most active
100%.
corporate development teams. So let's double click on that. So you are managing partner of TELUS Global Ventures. Tell us a little bit about TELUS Global Ventures, because from what you can see online and the activity, you've invested in more than, 150, 200 companies spanning 10 countries, 5 continents. Alone in 2023, you did over 30 deals, deployed over 175 million. You are a very active CVC. What does that look like in practice, though?
We exist to help drive the product roadmaps of TELUS. TELUS, at the most basic level, is evolving from being a traditional telco to a global technology and services business. And what that means is, lots of our competitors and similar companies, when they want to go and diversify the business, they go into media or entertainment content. We decide to go into value-added service verticals that leverage our understanding and knowledge of the network. We effectively build these verticals and eventually we spin them out. So we built a BPO business called TELUS Digital. We spun that out. It's now evolving from a BPO business into a very significant AI business. We're like the second largest AI annotation shop in the world. We have built TELUS Digital Health, TELUS Agriculture. We have a significant business solutions business, connected consumer, or an impact investor. So we have 5 sort of internal customers, and we help those customers drive their product roadmaps through the use of venture capital. And so we're a 28 billion US market cap business. We have to do a lot to help build those businesses. As you rightly pointed out, 30 transactions in 2023 and I think 28 in 2024. Our CEO, Darren Entwistle, we were talking about the year in 2023 and he said, "Awesome, great work, now do more." Right. and that's one of the reasons why we have so much support from the senior management of the business is they understand the value of this and there's continuity there. Darren's been the CEO for more than 20 years, 23, I think it is. And he understands how to use the tool of venture.
I mean, that's what it feels like great CEOs in this now time of how fast things are moving need to be focused on. Great, you did 30, do more, right? But talk about how you balance the difference between strategic returns for TELUS versus financial returns, and maybe touch on also the commercial agreement side that needs to be pushed within a couple of years.
The way we think about this is the way to drive those product roadmaps is to have a commercial deal. If you think about it in a very simplistic way, we can write a check. Lots of people can write a check, right? We can also be a customer. And so by being a customer, we do lots of things. We give the startup business. We also bring customer insights and we bring expertise in the area. But then there's a third leg of the stool, which we are very focused on, which is a platform services tool. And so we do things like provide a marketplace for goods and services that we offer or partners offer at discounted rates for our portfolio companies. We provide training. We're really good at go-to-market because we do it at scale. So we actually give portfolio companies specific training around how to go to market. So we think of ourselves as being really good investors. What it means is we actually build the business case from the beginning. So of the 90% of the deals we did last year, there's a commercial deal in place. So in 2024, we did $34 million in business with our portfolio. This coming year, 2025, we'll do 60. I don't care what business you're in. That's significant. In the last year, 90% of the deals we did in 2024 at a commercial deal. So we're very focused on what we call value capture. So either the portfolio company sells something to us and we reduce our OpEx, let's say, or we sell through us to our customers. We capture that value, and that's that $34 million. For us, what we do is we focus on IRR and that value capture and how much money we put in to get that value capture. So not to get too much into the sausage making, but like we talk about value capture and invested capital, and there's a ratio, right? It makes sense for us. If we put $5 million into a business, we want to see over 5 years, maybe 10 or $15 million of revenue for us. And that's the sort of math that we use to make those decisions.
It sounds very similar to the way that some of the banks operate as investors in venture funds like ours, in terms of not just the financial return, right, on that IRR, but also the strategic financial return because of the savings or the revenue generated through business lines. But of the 90% you say have relationships or business relationships, how many of those 90% were done before the investment versus after? Are a majority of them done usually after or congruently?
It really depends. And we have a substantial portfolio, and we look at, anywhere from 500 to 1,000, companies a year in terms of our funnel. So it really does depend on the nature and stage of the market that we're looking at versus the markets that we're in, et cetera. But a rule of thumb is it usually is concurrent. Sometimes we'll have an instance where we're doing business with a company and we realize we can actually significantly increase the value of the business by investing and pushing harder through our channels. Sometimes we'll do it, after. We'll make an investment or we'll make a commercial deal after. And it really does depend on the market.
Yeah, that makes sense. And also timing of when the deal is closing because there's other investors may not line up with your business, obviously timing as well. Like I said, you've invested across like 5 continents, right? 10 countries. How do you think about managing all of that operationally, as a global firm?
From the business side, my colleagues in the business units, there's always a sponsor. So we have direct accountability when somebody says, hey, we're going to sell this product in France. Like there's somebody in the business unit who's accountable to make sure that that's actually occurring. And then on the TGD side, we have various forms of representation. Sometimes we're a board member, sometimes we're an observer. Other times we have a pretty rigorous reporting and portfolio management structure. So we care about how the world is developing. And as such, we call ourselves social capitalists. So we ask our portfolio companies to report on important things like diversity, how they're running their businesses so that we can report to our shareholders and to our stakeholders, the people that we're giving money to. I say this all the time to the team. Our job is to get the right amount of capital into the hands of the right people, solving the right problems.
Yeah. You mentioned being social capitalists, obviously, but not all the other investors in the same companies have those types of motivations. So how do you kind of jive with the other investors in the companies, traditional VC funds or private equity firms? How do you find your role with them mixes?
You'll know this all too well from your own experience. I have a single LP, which makes my life easier in some ways, more difficult because, it's my CFO and he can text me at any hour of the day and he's in my shorts on a regular basis. It's one of the advantages of investing off the balance sheet is I don't have fund cycles to manage, right? As long as we believe in the long-term vision and are still getting the kind of things that we look for in the investment, I have no pressure to recycle capital. I have no returns that I have to provide to anybody else. We just manage it as an investment. As long as we're clear about that with our colleagues who are on the cap table with us, and we're clear about most financial investors are very happy to have us on the cap table when we sign a $10 million commercial deal. Like they're like, you're really welcome at the table,
Right.
We try to use the two to help and complement each other, commercial relationship and the investment relationship.
Okay, I'm going to go a bit off script and ask a question though that a lot of founders probably think about is how do we manage the R&D sort of product roadmap overlap when you have a strategic, but also potentially building into their purview, as well as sort of selling to competitors of yours from a customer perspective with the startup?
So we like to be really upfront about this stuff. Like nobody should take money from somebody and then find out that they can't sell to a competitor. Like if we're going to put money in, we're like, hey, we want to be able to offer this product to our customers in Canada or in this geography or in this vertical. And if the company wants to do it, then we do it. Again, I think the more successful businesses are, those relationships evolve over time, right? And
Right.
I can think of a number of instances where we're fairly significant investors and our side letters have become narrower and narrower and narrower and narrower. And that's, I think, probably the healthy way to manage the relationship. For the viewers of the podcast, like transparency is super important in any relationship. As you know, you're
Yep.
building a 7-year, 8-year, 10-year relationship. Everybody should know what the drivers are. And I'm super upfront when I'm talking to other investors. I'm like, we care about this. We think at some point we may buy it. We don't know yet. So we're just going to ask for a right. We're going to ask for some information rights, get early understanding if unsolicited offer comes into the business. We ask for all those things and we're transparent about it. And trust me, now more than ever, if you say, hey, we might buy the business, again, everybody wants to make sure you're happy, right?
Yeah, for sure.
We're a highly acquisitive business and we do good deals and lots of people are happy about the deals that we do.
Could you share the last publicly announced deal that you guys did and sort of what that relationship started off as and where it went to?
We invested in a company in Germany called Dryad, as you will have where you are living, West Coast, Canada and the US, Northeast parts of the US and Canada. Wildfire is a significant problem. And Dryad came up with a solution which was very, 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 very helpful in early detection of fire. When we made that investment, like a thesis of ours was like, hey, we can bring this to Canada. We have tons of customers who are in the natural resources industries and utilities and running railways. They have equipment in the middle of, big open areas. They want to know well in advance if our facilities are in danger. And so we said, hey, we want to bring you to Canada and we'll commit to volumes of selling because we're going to go out and sell to our customers. So not only do we have the opportunity to invest and help the business grow into North America, we created some rights where we're going to get a great offering for our customers in Canada.
You guys also acquired a company in Toronto, I think last year, Vumetric on the cybersecurity side, right?
Yeah.
That was a smaller
we're very
acquisition. Your tentacles are quite broad. You have a lot of different areas, public sector, commercial, healthcare. You've got the pollinator fund. Where do you get time to focus on all these different markets with things moving so quickly? Like, is there a annual thematic planning session on where this year is going to be focused, or do you just
100%.
kind of take where the wind goes? Okay. So tell us a little bit about that process.
Yeah. Last year we did 90% of the deals we did. We had a commercial deal in place. Best in class in corporate venturing is like 30 to 50%.
Right.
So like we're at the top of our game. And one of the reasons for that is we have a rolling strategy review for each of the business units. And we actually build with the business unit the strategy. And if you think about it, like venture is a tool. It's just like a hammer is a tool. And you can't say, I'm going to build a business I'm not going to build a house just with a hammer. You need multiple tools. Well, we do that with our business unit colleagues. We say, what's the strategy for the business? What's the appropriate tool to use for each of the areas that you're trying to build the business in? And if it's venture, we'll own that. We'll come back to you with here's 5 targets that will help you achieve your strategy in this area. This is the one that we recommend the best. We'll go after, we'll preempt if the business isn't raising money, and we'll go out and we'll do that work. And what that means is we've already got alignment from the start. And a lot of corporate venture funds don't actually have that tight an alignment with the strategy of the businesses they're investing in. And so it sort of becomes an afterthought. And I think the worst thing that a corporate venture fund can do is invest money into a company, have them think they're going to get business from the corporate, and then they don't, right? Like that's a bad outcome all around.
Who do you think the most acquisitive corporate venture group is? Salesforce, Cisco, Google? You're in the Bay Area. You must have a WhatsApp group with all the corporate development leaders.
So it really depends because some of them, corporate development is a very broad concept, right? Like some of them are purely financial, right? Some of them are purely strategic. And I mean purely strategic, which I struggle with, right? Like I don't think there's anything strategic about bankruptcy. So like there's got to be some financial measure there. Highly acquisitive, the most acquisitive, the biggest are Salesforce, Google, Intel. Intel doesn't acquire as much as people believe. They had a bit of I'll call it an ecosystem approach to things, but it makes a lot of headlines when they do. And generally they're paying top dollar. So all the big ones do,
Yeah.
all the tier ones.
Well, where do you think
Like
we are in the cycle then? Because it's been pretty quiet from a liquidity standpoint for investors in 2023. 24 moved a little bit. And in the beginning of this year, we've seen some pretty big acquisitions.
the public markets aren't open. I mean, there's companies out there that are doing $1 billion in revenue and still growing at 30 and 40% CAGR, and they're private and they're not
Crazy.
going anywhere, right?
Nope.
If you want to talk about like, where's the industry going? Like all these larger funds are becoming RIAs because they know that they want to continue to manage. One, if they do go public, they want to continue to hold because they think that they're giving up too much in the future. Two, they want to be able to continue to fund and keep the business private and not have to return the capital. There's a bunch of dynamics, but I think part of it is really about liquidity in the system. And so if you or any of the people that listen to the podcast are trying to raise capital from LPs right now, they all have like a big problem. In 20 to 2023, like people lost their minds and people invested entire funds in like a year and a half and then went back to their LPs and said, I need more. And those GPs were told no because they didn't have liquidity.
Yeah.
And it was really hard to, for LPs to, refund those GPs. So where do I see the industry going? I think there's a ton of private companies that need to get public in order to create liquidity events. I think because of that, actually investors are being stubborn on valuation. And so valuations for acquisition aren't going down as much as people would like. In our health business, I think we acquire a business a month. Like we're in market. We are in market. And as a result, like we see some of the valuations that people are asking for and they don't make sense. And they're primarily from investors who are like, we're stuck. We got to get liquidity.
Mm-hmm.
And
It feels like a tale of two markets, Terry. You've got like the AI and like the big deals like Wiz and then Windsurf and things like that, which are one side of the spectrum. And even those deals, how big the outcomes are not even returning, the entire funds for some of these investors that are so big, right? So that's one part of the dynamic. And then what you're saying is like, you're doing one deal a month, 12 deals a year just in healthcare. And the valuations that people got stuck on is probably nowhere near where you guys want to be. And then the pref stack issue as well, and all the other issues, people are just waiting it out. And there's just not a lot of buyers for these assets, especially if you're the most prolific one in that specific area. So would you say then that these companies need to get together? Like the ones that are all stuck in this private land and they're not appealing to you, would they be more appealing if they were able to get together, clean up their cap tables, clean up their operational structure, and then serve it up to you on a silver platter? Would that be appealing to you potentially?
possibly, yeah. But, remember when a business like TELUS acquires another one, it's really about the synergies that they can achieve through their own business, right? So that's the example I was using earlier. So if I acquire a company that's got a great product and I want to distribute it exclusively through to my customers, there's a finite amount of value I can extract there. And we can all play with the length of time over which we recoup that value. And for a company like ours that thinks in sort of 25-year chunks, like we can make the case at some point. So I don't know that cleaning up is helpful. If I were in a position where I was doing $1 billion a year, growing 30% CAGR, I'd just say, I'm going to become a significant, I'll taper off the growth, start paying a dividend and try to pay out and clean out some of the investors, turn around the business so it's an easier business to manage. And then I think at some point you're going to have to get liquid because everybody's got to get liquid at some point.
Yeah, it's going to be an interesting year, Terry. I want to switch gears for a sec because you have played a pretty significant role in the Canadian ecosystem while still living in the Bay Area. You were, very big in C100. You've been very adamant about helping more Canadian entrepreneurs. Obviously, Canada is in this sort of limbo period, hopefully changing course now. How do you think about the Canadian tech scene right now and its view on the global stage? And how do you see it evolving?
Thanks for calling that out. I'm extremely proud as a Canadian. I like the fact that I get a chance to, at least for part of my career, work for another Canadian company. I think Canada has an enormous amount to offer the world, and all of the efforts through the C100, through all of my extracurricular activities, it's all been around trying to figure out ways to help Canada become a leader in, I'll call it intellectual property driven or technology businesses. I think a shift towards those types of businesses is only for the better, diversifying the Canadian economy. I'm a little disappointed. BDC and Deloitte, I think, did a report not too long ago. I think BetaKit covered it off, where only 6% of Canadian corporates invested in venture over a period of time. The last, I think it was 2023 or something. The number's more like 40% in the US. And I really think you cannot drive your business without doing some form of, there's a very famous professor at Stanford. He had this organizational framework around exploitative versus exploratory. Two big forces in a business. Exploratory is venture. Let's go out, see what works, what we can get into that's new and grow the business. Exploitative is like, let's take a process, make it better, drive better performance, drive better margins, et cetera, et cetera. And when exploitative looks at exploratory and Terry writes a check for $10 million and a business unit looks at that and says, I could use that money to run my business. Like, why are you going and trying this hard thing? What's clear is the exploratory always drives better performance. It's really rocky because it doesn't work sometimes. And one tries to push out the other, right? And so here's my comment on the Canadian ecosystem. More corporates have to be supporting the ecosystem of startups in Canada, and they have to get more involved, and they have to try more things, and they have to buy from Canadian startups. And if they do that, Canada has amazing schools with amazing engineers, great, operators. Like, we have all the ingredients to be a number one player in the world. And we're getting there. Like, there's some work, KW has evolved. Montreal, Toronto are very significant Vancouver. Like, there's great ecosystems building in Canada, but they're not world-class yet. And they need to be world-class.
Terry, I am so freaking happy that you mentioned this, obviously, and I'm super aligned with you, but I'm going to push back on and pretend I'm going to be a corporate, CFO. Terry, I would say to you, that $10 million check doesn't move the needle for us. Terry, that is a distraction to our core business. Terry, that puts our reputation at risk. How do you justify that?
If you don't like change, you're going to like irrelevance even more. You're really not going to like irrelevance, right? If you can't get comfortable with change in the market, you will really, really not like being made redundant. I worked inside a company. I worked at Nokia, which was number one in the world in what it did. And it's a shell of what it is. It's a shell of what it was back then now. And so I've seen inside those businesses, it's super easy to get comfortable and arrogant and say, that's noise. If you don't stay on top of it, your business will die. And that's what I'd say to you as a CFO.
I would say it's also because irrelevance takes a lot longer in Canada to show. I think we have a lot of people working maybe on Bay Street or in corporate jobs where the risk of joining a startup versus the outcomes that we've seen to date have not overly compensated for those people wanting to leave those roles and join a startup versus what we've seen in the US based on, one, the capital invested, the capital available to pay these people and compensate them. And two, the value of those options and the equity ends up becoming really life-changing. And in Canada, we just haven't seen that yet. And so there's this kind of chicken and egg as well for people to want to take those bets.
I think you're right. Two important things that are worth calling out. One is that not everybody wants to work at a startup. And having worked in a high growth business like Checker, like, it's not an easy place to work, especially if you're at a certain point in your life and you've got dependents, et cetera, et cetera. So it's important to remember that there's different types of people. But then I agree, there haven't been as many exits or as many high profile outcomes where people are like, hey, I do hope that, Toby and Harley at Shopify, their success, people understanding just how important they are as a leader in their field, being in Canada, that there's a young woman in Chibougamau in northern Quebec who sees that and says, I'm going to go do that. It's possible. I can go do it. Harley can go do it. I can go do it. Right? If you create those sort of stories. Now, those people, and by the way, like Dan DeBow, like we just saw the Angel Conference recently, where you see a lot of very important angel investors in the ecosystem being recognized. And DeBow is a good example, like great human. They're putting money back into the ecosystem and recycling our capital. And that has to happen as well. And we should make sure that like a tax and regulatory
That's what I was going to
perspective,
say.
that has to be, those incentives have to be there. And it can't be just government driven. Like we have to create a framework where people feel incented and want to invest in these types of companies instead of the government saying, we're going to take the money and then we'll distribute it.
100% agree. The subsidization of capital investment is not what we're asking for. We're saying just give the incentive to create that flywheel, right? As there was part of the conservative platform to have this reinvestment deferral on capital gains, we need to see that coming out of the liberal platform. But hey, we will not diverge into the Canadian politics right now. I guess the one thing I will say to you is having people like you, Terry, who've seen it at global scale with Nokia is the exact kind of people we need, educating not just the next generation of like startups founders on what to look at around the corner and some of the things that could knock you off your trajectory, but also the corporate leaders in Canada as well, who are still feeling like it's not worth, the juice is not worth the squeeze. It's not necessarily just about that, because look how big TELUS is and look how much Darren, the emphasis he puts on the innovation agenda and the exploratory agenda versus just the exploitation part.
I participated in a Business Council of Canada and tried to bring sort of an outside perspective to the leaders of Canadian corporates. And there's more there than you think. And we invest in companies. We're optimistic by nature. I am optimistic that the cultural change is occurring. It's not occurring at the speed that I would like to see it at, but it is occurring.
It is happening.
Probably more importantly, I think as leadership starts to evolve in those businesses, and quite frankly, like I've always said this, like if you're Canadian business, you should be thinking globally. You should be thinking about being the best in the world, not just being in Canada, but selling to all markets. And again, we have so many inherent qualities that allow us to lead globally. We have incredible diversity in our population. We have access to those countries through that population from, employees and leaders in those businesses. Like there's just so many good things that we could use to leverage leadership across the globe.
Absolutely. I could talk about this for hours with you, Terry, but I'm not going to hold you to that. So before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
So good one. I actually I lived in London for 6 years. And so I kind of got addicted to The Economist and the podcasts that they do. So basically anything that The Economist I listen to on a fairly regular basis. They have some great ones, Follow the Money. There's some American ones that I'm very interested in global affairs. So I tend to listen to things like the President's Inbox, which is the CFR, one of the CFR ones. So I'm a bit of a policy nerd at heart. And, I love all day to think about the next thing, but I also love to understand how countries, interact with each other. So that's a big one for me.
Nice. Next is your favorite newsletter or blog?
My favorite newsletter right now is a friend of mine, Alex Lazaro. He's another Canadian in the Bay Area. Such a smart guy, has an amazing track record investing for a number of funds, most recently Cathay, but he has a fund called Fluent, and he has a newsletter called 99% Inspiration, I think, 99% Inspiration.
Okay.
Great newsletter. He thinks about, in my simple terms, idea arbitrage. Something that's working in Silicon Valley, how can we take it to West Africa?
The rocket internet model.
Yes. Yeah.
Nice. Next is your favorite tech gadget?
I'd love to say that I'm
your Nokia
doing
phone.
enough of it. No, I'd love to say that it's getting enough use, but my main form of sleep and stress management is getting on a bicycle. And so I have a head unit, a computer for my bike, and it's called a Wahoo.
Of course.
And I love my Wahoo. Sadly, has a very close place in my heart because it reminds me I need to do more miles on the bike.
That's awesome. The Wahoo was a big thing in COVID for sure. Next is your favorite new trend?
Docker. You wouldn't get through this whole discussion without the term AI popping up. We love the fact that we're shifting now into things like observability and tools because we think that, and more importantly, call them vertical LLMs. And so we happen to have a lot of information, a lot of data that we can use to make good outcomes for people. The fact that we're sort of shifting in AI to those types of things for me, I think is super interesting, both from a personal perspective and from a professional perspective, that I can take all the data that I've been collecting. I was a Polar user like 20 years ago. So if I could if I could upload all of my heart rate variability for the past, 25 years and all the exercise and have that very specifically around coaching me to be a better, cyclist, down with that all day long.
I think that's what Whoop has obviously been gunning for since they launched, and they have actually a big launch out today. So we'll see what they announce. But next is your favorite book.
This is a hard one because I tend to like to read fiction before I go to sleep, because if I don't, I'll start to churn and think about too many other things if it's nonfiction. Malaby's book on the power law is obviously,
Of course.
something that you and I will think about or have read, several times. But I find it actually really helpful to explain the industry to other people. And, half of my job, I would say at TELUS, is about teaching people within the business how to use venture. And so they get a better understanding of what it means. So I've been gifting it like crazy to see.
What's one of your favorite anecdotes from that book that still sticks with you? Is it the old Sequoia days? Which ones?
I'll tell you, a lot of people give Masa-san a lot of grief.
In our industry or outside of the industry? Or both?
Both, I think. I think.
Fair.
I say this because I've been in meetings with him. He's an unusual human being. Let's put it that way. But the fact that he was willing to risk everything so early, it's an unusual set of circumstances that somebody who is that successful, but he's answering emails on a Saturday morning at 7:38. Like, the drive to get up every day and continue to do that is super eye-opening to me. And long may that.
The emotional intelligence, the high EQ with Masa, and maybe Vinod, is what keeps them going, meaning they keep getting motivated to wake up every day to continue to chase that high emotional intelligence performance, but also not to get bogged down in the downtrots of the bad days. And so and not let them eat away at them, nor do they get overly exuberant and excited and feeling like they're the smartest people in the world when things go really well.
Yeah. The amount of experience both of them have probably flattens out the top and the bottom. For sure. The motivation for each is, I don't know that I could speculate on that, but I think what makes them really interesting as investors is how much they've seen, how they can put it in perspective. But it's clear that the curiosity, is there. I say this to the team all the time, and it's not mine. I'm not going to take credit for it, but I try to remind myself of it every day, which is the future belongs to the curious. And if you maintain that curiosity, a level of humility and a growth mindset, like a learning mindset, you go into every opportunity, podcast interviews, meet a founder, whatever, as an opportunity to learn and as an opportunity to think about what you know and whether or not it's correct. And if there's outside data points that you can take in. Like, I think that's what makes them really successful and continuing to do it, is that they're genuinely curious and they want to understand, like, how can they play a part in the future?
10,000 coffees. I mean, it's that methodology. You got to have coffee with 10,000 people to get to Warren Buffett or something. So I love that. All right. Well, last but not least, your favorite life lesson.
It sounds so cliche, but like, I've lived it enough in my own career that I do try to remind people of this. I remember some of the high points of my career quite well. I really remember the times when I got knocked down and I got back up. And I learned more from getting knocked over and the drive to get back up off the ground. And by the way, the people who were beside me when that happened, man, you really learn a lot. You learn a ton about your friendships and what you value in friendships from those types of parts of your life. And so I would just say, one, David Brooks is a really impressive human being. He has a couple of really great books, but he said recently, really difficult times can either break you or they can break you open. They can make you hard, they can harden you, or you can use the pain and difficulty to learn about yourself and to become a better person as a result. And sometimes you just have to sit with the pain and say, all right, what's this going to teach me?
Totally agree. Unbelievable quote. to break you or break you open. This has been fantastic. Thanks so much for joining us at the Tank today with Terry Doyle, managing partner at TELUS Global Ventures.
Thank you.